This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Blistering pace, home prices are rising to levels never seen before, but there's something missing from this housing recovery.
Buoyed by buybacks. Why earnings growth may not be exactly what you think.
Safety nets. Will Social Security and Medicare be there when you need it? All that and more tonight on Nightly Business Report for Wednesday, July 22nd.
Good evening, everyone. I'm Sharon Epperson, in tonight for Sue Herrera.
And I'm Tyler Matheson. Welcome from me as well. Homes are officially being bought and sold at their highest prices ever. And those rising prices aren't holding buyers back. They've come out in droves this spring and summer selling season, pushing the pace of sales to their highest level since before the financial crisis. The National Association of Realtors says sales rose 3.2% in June, helped by steady job growth and an improving economy. That report helped send shares of home builders higher, even as the broader market fell today. And while it may seem like the housing recovery is firing on all cylinders, Diana Olick tells us there's something that's just not right.
The numbers for the spring market are in and strong. June home sales rose more than 3% from May and are now up nearly 10% for the year. That's the highest monthly pace in over 8 years. But those sales came at a high price. The median existing home price hit $236,400, the highest ever. That's due to tight supply, barely up at all from a year ago.
At some point, there will be a choking point with prices rising, and also we are facing a rising interest rate environment that hurts affordability. So we may begin to see buyers being choked off, not because of lack of desire to buy a home, but just the price increase is preventing many people from able to buy a home.
Median home prices are also skewing higher because higher-priced homes are selling more than cheaper ones. Sales of homes priced below $100,000 actually fell from a year ago. Still, despite higher prices, mortgage bankers now feel better about their business. Today, they revised their forecast of purchase loan volume higher from $730 billion to $801 billion. A sharp jump, they say, based on more borrower applications approved, fewer all-cash sales, and some loosening in mortgage underwriting. Mortgage purchase applications, though, are down over the last month, signaling high prices may now already be taking their toll.
We're already seeing at Redfin that demand is weakening. Buyers are less and less willing to go to the top of their budgets to buy a home. And as that kind of trickles down, we'll see fewer sales.
A slower second half, perhaps, but a better year overall. For Nightly Business Report, I'm Diana Olick in Washington.
Anika Khan joins us now to talk more about her outlook for the U.S. housing market. She's senior economist at Wells Fargo. And Anika, the last time we talked, the news wasn't nearly as good. We have very strong data on existing home sales, and we've had strong data for several reports. What's really driving what we're seeing right now in the housing market?
Yeah, you're right. The housing report today was a very solid report. It was up more than 3%, and it comes on the back of another strong increase in the previous month. So we're seeing that the housing market is moving in the right direction. We're also seeing a whole host of other housing indicators like housing starts, permits, and pending home sales increase. What's really driving the market is the rise in household formations as well as a better labor market. And we could also be seeing some potential buyers jumping into the market to beat the rate hike.
Who's buying, who wasn't buying, Anika?
Great question. So who is buying? We still are seeing that the share of first-time home buyers is low relative to historic norms. But we've seen that share has increased in recent months. And so 30% of first-time home buyers came into the market. A lot of those first-time home buyers are millennials. And of course, some of those millennials are using government-sponsored low down payments to be able to get into the market.
And what we're seeing here from millennials and from who is now in the housing market, what are some of the economic benefits of what we're seeing with this little housing boom?
Yeah, so when we look at the economic impact from a real GDP standpoint, the housing market will finally start to give a bit more of a boost to real GDP headline. which will offset some of the negatives that we're seeing in net exports. We're also seeing a slower pace of growth in the second quarter in structures and inventories. So it's a well-needed boost.
All right, Anika, thank you very much. We appreciate you being with us. Anika Khan with Wells Fargo Securities. Wall Street seemed to be suffering from a tech earnings hangover following the profit reports from Apple and Microsoft that we told you about last night. Both of those stocks were the worst performers on the blue chip Dow index today. Encouraging results from Boeing and Coke just weren't enough to lift the indexes. More on those companies in just a moment. By the close, the Dow Jones Industrials were off 68 points to 17,851. NASDAQ declined 36 and the S&P 500 lost 5.
More now on Boeing's results, which beat expectations as plane delivery surged. That made the stock one of the bright spots today, rising 1% on the day despite cutting its 2015 earnings forecast. Phil LeBeau tells us why investors were so encouraged by the results.
On the wings of a strong performance by its commercial airplane division, Boeing's 2Q earnings were better than expected. The Dow component beat the street consensus by 25 cents a share with stronger than expected revenue. One big factor is the company's commercial plane business. Boeing delivered a record 197 airplanes last quarter, 34 of them Dreamliners, as Boeing is building the 787 at a rate faster than planned. Meanwhile, the company's operating cash flow was a very healthy $3.3 billion last quarter. New CEO Dennis Muilenburg says Boeing is in position to take advantage of future opportunities.
I think if I look at big opportunities and risks, certainly going forward, our opportunity to execute on our commercial aircraft backlog and to do that profitably and return cash to shareholders and fund our future innovation, that is the single biggest opportunity we have.
Muilenburg admits Boeing still faces challenges with the tanker program after taking a charge last week of more than $500 million. But Boeing's stock has long been driven by the success or failures of the company's commercial airplane division. And right now, that business is soaring as we fly into the second half of this year. Phil LeBeau, Nightly Business Report, Chicago.
And today, Boeing landed its largest ever order for its 767 jetliner. FedEx says it plans to acquire as many as 100 new freighters worth nearly $20 billion. The deal includes a firm order for 50 new aircraft with the option for 50 more.
Fellow Dow component Coke turned in a strong quarter despite the impact of the strong dollar and a drop in sales of Diet Coke. World's largest beverage company saw its overall sales volume rise more than expected and reported strong demand for its non-soda products like teas and water. The company was also able to raise prices, and its smaller cans and bottles led to bigger sales. Nonetheless, shares of Coca-Cola fell fractionally. American Express, also a member of the Dow, topped earnings expectations but took a hit from the stronger dollar. The credit card issuer earned $1.42 a share, 10 cents better than forecasts. Revenue, though, missed and fell from last year, coming in at $8.2 billion for the quarter. Shares were initially lower after the results. Our Mary Thompson's here with the one key takeaway from the report. The earnings were a little soggy, I guess.
They were, but I think what you have to have here is patience. That's the key takeaway from this report. This is a company that is continues to miss revenue targets. It has for a long period of time. It beats on the bottom line because it's very strict about cost controls and share buybacks. Nevertheless, the company has to spend in order to boost its revenue. It's been very open about that. It's increasing spending in the second half of the year. Earnings are going to take a hit from that, and that eventually should hopefully help the company retrieve lost revenue, like the revenue it's losing because it's losing that exclusive relationship it had with Costco. So again, the company in this quarter hurt by the stronger dollar, but in the quarters ahead, it's going to be hurt by its own spending as it looks to boost revenue.
Quick follow-up. What does it spend on to generate revenues? Is it advertising?
Advertising. It spends on a variety of its growth initiatives, some of the digital initiatives the company has introduced, new card memberships, members, et cetera. So it's spending money to get these people in the door. It's spending money on co-branding relationships. It has to do that in order to grow its revenue, get it to that 8 to 10% target that the company has as a long-term target for revenue.
And that's when investors going to want to see that they're growing that revenue from the next quarter.
Mary,
all right, thank you.
Thank you.
And today may have been a busy day for earnings, but tomorrow promises to be even busier. There's one company scheduled to report that could provide a read on the global economy, and that's Caterpillar. Today, the Dow component said sales of machinery by its dealers fell for the 3-month period in June. And as Dominic Chu reports, that could be a troubling sign.
When it comes to which stocks to watch as an indicator of global economic health, few are more closely followed than Caterpillar. It's one of the world's biggest makers of heavy equipment like dump trucks, bulldozers, and drills. And there's a reason why so many investors care about its financial results.
It's a bellwether, an American company. Products are made here in the United States. We have to look at the strong dollar and what effect does it have about global demand.
So, here's what Wall Street analysts are expecting from Caterpillar tomorrow morning. Estimated earnings per share of $1.27 on sales of $12.6 billion. Beyond just the headline numbers, investors will be looking for any kind of commentary about future demand for Cat's products.
The biggest thing to look tomorrow morning is really the forward-looking earnings, forward-looking expectations. That's the biggest thing we're really going to look at.
But Caterpillar is just one data point and the tip of the iceberg when it comes to what's happening in the world of oil and gas, metals, and mining. Ben Mandel is a global strategist at JP Morgan Asset Management, and he's watching the bigger picture of what's driving the recent weakness in commodity prices.
I think a major challenge for the industrial sector is the fact that commodities look fairly weak and the outlook is somewhat bearish. And it's hard to construct a very positive view on oil, which is the root of commodities. A particularly relevant factor is global demand, which has been coming down. And the basis for global demand coming down in turn is a weakening China and really emerging markets driving that.
So far in 2015, Caterpillar shares have been among the worst performers in the large cap Dow Industrial Average, due in no small part to the weakness in commodity markets. Now, traders have pushed the stock to 6 straight days of losses, so tomorrow's earnings from Caterpillar could do a lot to either add more fuel to that downside momentum or provide a reason for at least some optimism. For Nightly Business Report, I'm Dominic Chu.
As investors and Wall Street both focus on earnings and especially earnings per share, Bob Bazzani explains why those critical numbers sometimes aren't all they're cracked up to be.
One thing that's been overlooked this earnings season is the big influence buybacks have had on those earnings. Buybacks usually lead to a reduction in the share count outstanding, and that translates into higher earnings. That's why investors like buybacks so much. And the buyback craze continues into this quarter. 20% of the S&P 500 have reduced their share count by at least 4% in each of the last 5 quarters. That's a lot. One shining example is Apple, which has reduced its share count by more than 10% in just the last 2 years, meaning earnings are 10% higher than 2 years ago, all other things being equal. That's an increase in earnings independent of any sales increase, independent of cost reductions. You see why investors love buybacks? Many other companies have been aggressively buying back shares as well in the last year. They include Bed Bath & Beyond, Yahoo, Sherwin-Williams, Harley-Davidson, AutoZone. Some companies have become buyback monsters. This is my phrase. They're aggressively buying back their stock year after year. One good example is IBM. They have reduced their share count by 22% in the last 5 years. Is there a downside to buybacks? Yes, there is. Many investors want companies to put that same money to work growing the business by increasing sales or innovating with new products. So here's the bottom line. Use financial engineering like buybacks to increase earnings is fine, but it's no substitute for growing the company. For Nightly Business Report, I'm Bob Bassani at the New York Stock Exchange.
Still ahead, Social Security and Medicare. Will they be there when you're ready to retire?
That somewhat soft retail sales number that came out last week we told you about may not have been just a one-time blip. Today, the National Retail Federation revised lower its forecast for overall 2015 retail sales and said it expects back-to-school revenues to fall from last year.
As a result of economic and maybe more importantly some political headwinds, we've got to revise, and so we're announcing today we're going to revise our annual retail sales forecast to 3.5% for this year. That's what we had to do last year. We think it's unfortunate. We're ready to grow, but we need a little help from Washington, and we're just not getting it.
And some of the things the Federation says it would like Washington to focus on include tax reform and infrastructure spending. And meanwhile, in New York City, the proposed bill by the mayor to curb the expansion of Uber, the popular ride-hailing app, has reportedly been scrapped. According to the New York Times, the city won't seek a cap on the number of new Uber drivers permitted to operate in the boroughs. In exchange, Uber agreed to participate in a 4-month study on traffic congestion. Sharon, I can tell you the answer to it. The congestion's pretty bad.
Yes, it is. Well, you know, there have been a handful of victories for organized labor to tell you about. In New York State, a panel appointed by the governor said that the minimum wage should be raised for employees of fast food chains throughout the state to $15 an hour. Then across the country, Los Angeles County took a step toward lifting the minimum wage to that same amount. The move would affect hundreds of thousands of workers and is similar to the action taken by the city of Los Angeles. And separately, the University of California system announced plans to increase base pay for its employees and contract workers to $15 an hour over the next 2 years.
Also in Washington, the government said the financial outlook for both Social Security and Medicare remain uncertain. The annual report card out today from the trustees went so far as to say that the 11 million people who receive Social Security disability payments face steep benefit cuts next year. John Harwood is in Washington. John, what did we learn about the financial health of Social Security, Medicare, and indeed that disability trust fund?
We learned that it still needs help, Tyler. The Social Security reserve runs out in 2034. That is actually a year later than projected last year. But the Social Security Disability Fund, as you mentioned, its reserve runs out next year, which was the same as was projected earlier. They need more money, and the same is true of the Medicare Hospital Insurance Trust Fund, which is due to exhaust its reserves by 2030. Also the same as projected last year, but the problem hasn't been dealt with.
The disability issue has been one that has been faced before. How can we deal with that? How can Congress deal with that? What is being planned, and how much more money is going to be needed?
Well, Republicans are insisting on a reform, an overhaul of the program. They think too many people are on it. There's too loose an eligibility screen. Nancy Pelosi, the House Democratic leader, said today that the Congress needs to step up and fund that shortfall now and not let the reserve be exhausted. So there's a partisan fight over that. I suspect more money will be appropriated in the end, and there will probably be at some point a reform of that program, but probably when a new Congress and a new president address the problem overall of Social Security.
What would happen if the main Social Security Retirement Trust Fund or the Medicare fund runs out of money? What happens then?
Well, they can still pay benefits. What we see in the trustees' report is that through 2089, they can still pay 75% of currently planned benefits, but a 25% cut is a lot. That's the amount of the shortfall. Be made up either by tightening eligibility, by cutting inflation adjustments, or by raising taxes. All of those are on the table in various ways from Republicans and Democrats. Republicans lean more toward trimming benefits, Democrats toward raising taxes, and that's going to be a big issue in the 2016 campaign.
Fascinating stuff. John Harwood, as always, thanks very much. John Harwood in Washington.
Tyler, disappointing drug data weighs on biotech, and that's where we begin tonight's Market Focus. Eli Lilly, Biogen Idec, and Exavant all reporting results for studies for potential Alzheimer's treatments. Biogen says its drug has slowed cognitive decline in some patients in a small study. Exavant's data didn't impress, though. Lilly's was the bright spot, with its treatment looking more promising to investors. Eli Lilly rose a fraction to $86.38. Biogen Idec tumbled 4% to $391.74. Exavant fell the most, off more than 6% to $18.16. Home Depot is buying a repair products marketer called Interline Brands for nearly $2 billion. This is the firm's biggest acquisition in nearly a decade, and it's an effort to capitalize on the rising number of renters and the repairs that are needed for their units. Shares of the Dow component rose about $1 to $114.90. And another deal to tell you about, St. Jude Medical will buy Thoratec for nearly $4 billion. Thoratec makes a promising type of heart pump, which will expand St. Jude's offerings. Thoratec surged 10% to $63.46. St. Jude fell a few cents to $76.67.
Investors buying up shares of Blue Buffalo like a hungry cat in that company's trading debut. The firm, which makes healthy pet food, raised nearly $700 million after shares were sold at $20 apiece. The stock closed at $27.20. That's a 36% gain. Weak outlook, though, weighing on shares of Tupperware in today's session. The container maker posted second quarter net that beat, but revenue slid as the strong dollar hurt sales. Current and quarter full year guidance also missing the mark. The stock down 8% to $59.01. Qualcomm late today announcing mixed results and news it will cut 15% of its workforce. That, it says, will save the firm about $1.5 billion. The firm says it might break itself up as it delivered its third profit warning this year. It also cut its revenue forecast. Shares of the chip company popped initially in after-hours trading, but then plummeted. Before the close, the stock was off more than 1% to $64.19. And Texas Instruments reported a decline in quarterly revenue, hurt by demand for its chips for communications equipment. Results missed on both the top and the bottom line. Shares volatile after the close. In regular trading, TI was off about 2% to $49.30. And coming up, a part of the energy market that's flying under the radar even as it attracts a lot of investment dollars. Here's what to watch tomorrow. Huge day for earnings. One, if not the busiest of the season. Dow Components, McDonald's, Visa, and as mentioned, Caterpillar all reporting. And a read on the labor market, weekly jobless claims results. And that, folks, is what to watch for Thursday.
Wells Fargo is now the most valuable bank on the planet. The San Francisco-based firm recently surpassed Industrial and Commercial Bank of China as the lender with the largest market value, which is approaching $300 billion. Just to put that in perspective, that's about $40 billion larger than J.P. Morgan's market value.
And here's a surprising new fact. An investment popular with retail investors like you and me is now bigger than the one that contains all the smart money. According to the research firm ETFGI, okay, there you go. There's now more money in exchange-traded funds than in hedge funds for the first time ever. There's nearly $3 trillion invested in more than 5,800 exchange-traded products.
And Tyler, here's another statistic for you. Gold prices have fallen for 10 straight sessions. Now, I covered that market for years, and I can tell you that is the longest losing streak since 1996. Meanwhile, oil prices today settled below $50 a barrel after government data showed U.S. crude inventories rose last week. And while oil tends to grab all of the attention in the energy markets, there's another area that's getting a lot of investment dollars. Morgan Brennan tells us what it is.
Thanks to the onshore drilling boom, U.S. natural gas production has surged more than 40% since 2005. Yet there's only one way to transport the fossil fuel in large quantities: pipelines. And there aren't enough. As demand from end users like power plants continues to climb, energy and utility companies are plowing billions of dollars into new infrastructure projects to transport, store, and process nat gas. Data firm Bentech Energy estimates $54 billion has been invested in new gas pipeline capacity since 2009. Nearly double that, $104 billion, will be spent from 2016 through 2018. Experts say even with nat gas prices under $3 per British thermal unit, demand for infrastructure won't slow, even if production does.
In the Northeast as a whole, you have about 25 billion cubic feet per day of new project capacity proposed in that region. And I would say at least around 20 or so of that project capacity is fully backed by shippers. So those projects that have those backings are very likely to move forward.
The lion's share of projects target the Northeast, where the gas-rich Marcellus and Utica shale formations currently at yield a quarter of all U.S. nat gas production. Research firm IHS Sierra expects to see 17 pipeline projects in the Marcellus over the next 3 years. And the flow of gas in these pipelines has changed as well, as power plants in the South and Midwest use more gas for electric power generation, and as petrochemical facilities and terminals exporting liquefied natural gas along the Gulf Coast look for more as well. Among the companies building out new networks or expanding existing ones are Kinder Morgan, Sempra Energy, and Williams Companies.
Analysts say the ever-growing need for infrastructure is also sparking a wave of M&A activity. In July alone, Marathon Petroleum subsidiary MPLX announced its nearly $15.5 billion acquisition of MarkWest Energy Partners. That's a deal focused on nat gas transportation and logistics in the Northeast. And Williams Companies said it received a takeover bid from Energy Transfer Equity, which owns 70,000 miles of pipeline itself. Energy Transfer has reportedly said it will pursue that deal whether Williams cooperates or not. For Nightly Business Report, I'm Morgan Brennan.
I don't know about you, Sharon, but I'm feeling disoriented. We haven't talked about Greece in about 3 days.
Oh, I know, but we will soon.
It'll be back.
It'll be back. It'll be back. But that is Nightly Business Report for tonight. I'm Sharon Epperson. Thanks so much for watching.
I'm Tyler Matheson. Thanks for me as well. Have a great evening, everybody, and we'll see you back here tomorrow night. Maybe we'll even talk about Greece.
We probably will.
Probably will.